Bitcoin just triggered a warning signal that has the entire market on edge. While most retail traders are waiting for a bounce, the data suggests a much deeper correction is already in motion. The next 48 hours will determine if we hold support or face a catastrophic slide. This content is provided for informational purposes only and should not be considered financial advice. Market conditions can change over time. The digital asset landscape is currently navigating a period of intense turbulence as we close out January 2026. Market sentiment has taken a sharp turn toward extreme fear, with the sentiment index plunging to an alarming 16. This dramatic shift comes after a grueling 6-day losing streak that has wiped out billions in market value, a sustained period of decline not witnessed since the previous quarter. According to reports, the mood on the street is the most pessimistic we have seen in months, reflecting a profound loss of confidence among short-term holders. Investors are grappling with a complex and challenging macroeconomic environment where traditional safe havens are suddenly outperforming digital gold. This is not a simple crypto correction. It is a systemic rotation of capital driven by fear and uncertainty in global markets. As per on-chain data, liquidity is rapidly rotating out of the crypto sector and into precious metals, a classic flight to safety trade. Gold has surged past $5,600 per ounce, marking a significant year-to-date gain, while silver has hit record highs of $120, demonstrating the market's preference for tangible assets in times of volatility. This massive shift in capital is leaving Bitcoin vulnerable as the primary risk-on asset, a position it has held for the better part of the last 2 years. The broader market is also reacting to uncertainty surrounding Federal Reserve policy. The Fed has maintained interest rates at 3.50 to 3.75%. And the lack of a clear dovish signal for future cuts is dampening the risk appetite of institutional players. This monetary policy ambiguity creates a challenging backdrop for assets like Bitcoin that thrive on abundant liquidity and low interest rates. The combination of extreme fear, a sustained downtrend, and a challenging macro environment has set the stage for the critical price action we are witnessing today. The core of the current crisis centers on a decisive break in price action that occurred on January 29. Bitcoin plummeted over 6% in a single day, touching an intraday low of around $83,383. This move represents the lowest valuation for the asset since late November of last year, effectively erasing 2 months of consolidation. Analysts note that the failure to maintain the critical $88,000 level was a major psychological and technical blow, opening the door for a much larger retracement. The speed and severity of the sell-off suggest a forced unwinding of positions rather than organic profit-taking. The selling pressure was intensified by external geopolitical factors, specifically the announcement of price floors for rare earth minerals. This unexpected news triggered a sharp increase in global market volatility, with the volatility index trading above 40. This macro shock acted as a catalyst for a broader sell-off in tech and risk assets, with Bitcoin bearing the brunt of the impact due to its high correlation with the Nasdaq in recent months. According to reports, fears over AI spending and corporate earnings have also bled into the crypto markets, creating a perfect storm of bearish catalysts. Large technology stocks, which often lead the market, have shown weakness, and this sentiment has directly translated into a lack of buying interest for Bitcoin. The sudden volatility has forced a reevaluation of the short-term outlook, as the previous consolidation range, which had offered a sense of stability, has been decisively breached to the downside. This breakdown confirms that the bears are firmly in control of the market narrative. The underlying on-chain metrics paint an even more concerning picture for the immediate future, providing concrete evidence of institutional capitulation. Institutional interest, which was the primary driver of the previous rally, appears to be cooling rapidly. As per data, spot Bitcoin exchange traded funds recorded a staggering $1.137 billion in net outflows over a 5-day period, spanning from January 20 to the 26th. This is the heaviest weekly exodus recorded since the very beginning of the year, signaling a major reversal in institutional sentiment. The outflow was highly concentrated, led by major funds which saw hundreds of millions leave their products. This institutional retreat is mirrored in the derivatives market, where $9 billion in Bitcoin options are set to expire on January 30. Reports indicate that a massive 97% of call options are currently out of the money, meaning the vast majority of bullish bets placed by traders have been rendered worthless by the recent price drop. This options expiry is likely to exert further downward pressure as market makers hedge their positions. Furthermore, the liquidation data is staggering. Over $319 million in leveraged positions were wiped out in the latest move, with long positions accounting for over 96% of the total. On-chain alerts also highlighted a massive $400 million deposit spike to exchanges earlier in the month, which served as an early warning sign of the impending sell-side pressure that we are witnessing today. This whale activity, often misinterpreted as accumulation, was in fact a clear signal of intent to sell. Interpreting these developments requires a detailed look at the critical technical boundaries that now define the market. Expert commentary suggests that Bitcoin is currently testing the lower limits of a multi-month consolidation range that has held since November. The current price of around $83,000 is a pivotal level, and a failure to hold this support on a closing basis would confirm a continuation pattern to the downside. If this level is lost, the technical path toward $79,000 becomes the most likely scenario, as this area represents the major support established during the previous correction bottom. Analysts note that the relative strength index is slipping toward 35, which indicates that while the market is approaching oversold conditions, there is still significant room for further downside before a meaningful bounce can occur. The bearish crossover on the momentum indicators further confirms that the trend is firmly in the hands of the sellers, with no immediate signs of a trend reversal. According to analysts, the primary resistance now sits at $91,000, which aligns with a key Fibonacci retracement level. However, the ultimate trend-defining level is the $98,000 mark, which represents the 200-day moving average. Until Bitcoin can reclaim this level, the long-term trend remains firmly skewed to the downside. The current structure suggests that we are in a distribution phase where large, informed holders are systematically offloading their positions to retail investors who are hoping for a quick recovery. A classic pattern seen at the end of major market cycles. The market is currently trading about 20% below the 200-session exponential moving average, a clear sign of bearish dominance. Looking ahead to the next 1 to 4 weeks, the outlook remains heavily weighted toward the bears, with the immediate focus on holding the $80,000 psychological level. If the current support at $83,000 is lost, we should expect a rapid move towards $74,000 target, which is the primary short-term bearish objective identified by technical analysts. This level would represent a 40% drop from the October peak. In a more extreme scenario, some analysts are warning of a potential slump to the $50,000 range, citing historical halving cycle theories and the lack of immediate bullish catalysts. This ultra-bearish target is based on the idea that the market must fully reset before the next major bull run can begin. However, a balanced view must consider the possibility of a relief rally. If Bitcoin can find a floor near $80,000 and consolidate, we might see a move back toward $90,000 to test the newly formed resistance. This would require a significant stabilization in ETF flows and a cooling of the current macro tensions, especially regarding the geopolitical shocks. Much will depend on the upcoming economic data and whether institutional buyers see the current dip as a strategic entry point. The market is at a critical crossroads, and the next few days will be critical in defining the trend for the rest of the quarter. Given the current extreme fear in the market, do you believe this is the ultimate bear trap before a massive move higher, or is this the beginning of a much deeper crypto winter? Where do you see the price heading by the end of February? The situation with Bitcoin is evolving rapidly, and the data suggests we are in a high-stakes environment. Make sure to stay disciplined and monitor the key support levels we discussed. If you found this analysis helpful, please subscribe for more data-driven updates. What is your price target for the coming weeks? Let us know in the comments below.